What are some of these ways that we could beat inflation with digital assets?
One way is you want to be that sovereign, right? You want to buy Bitcoin, right? I mean, in theory, Bitcoin has done over 100% annualized return over the last decade. So that performance may consist at some level for the next decade. So I think that's a great way to be able to also self-custody your own assets and participate in that upside. Another way is through a lot of the, let's call it the layer one blockchains, right? I mean, there's a lot of ways that you can provide liquidity in exchange for rewards or securing those networks where you could get staking rewards. Another way to maybe earn a 3 to 10% annual interest while participating in that upside. There are, in this space, many different yield providers, right? From DeFi to hedge funds, right? So DeFi protocols like Aave Compound, maybe you deposit your assets, your USDC, which is, 1 for the US dollar, and make right now probably running about 2 to 4%. May not quite beat inflation there yet, but hey, look, it's better than zero, right? And it's better than the banks. That's what we're trying to do. We're trying to beat out the banks. You can go to a CeFi type of platform. How we kind of look at CeFi is really just, it basically creates a centralized service and then bridges that to a decentralized service and kind of is that intermediary that aggregates the yield for you on your behalf. And then they take a spread and then they pay you a fixed rate return for doing basically all the work in DeFi for you. So for a lot of people that may be listening and get overwhelmed by going into DeFi and kind of managing all these different wallets, they might want to use one of these providers that do all the work for them and then just pay them out that 8% or so to kind of keep up or beat inflation, right? That's a great passive way to get exposure. Outside of those CeFi providers, then there's also certain funds that, like similar to what we're doing, where it's like structured as like a debt fund, which is a registered offering. Unfortunately, only accredited investors can participate here in the US because of the guidelines. That may change in the future, just not yet, right? These funds go out and create different strategies where maybe they're deploying a portion of their assets into platforms maybe like DYDX, where they provide liquidity and they're earning rewards somewhere between 10 and 30%. They also make investments into other companies that are more long-term. They also have a portfolio of crypto assets where they're managing that book and staking them for the rewards. And last, I would say some of these funds are also maybe participating in options, right? To protect that downside for that investor and the portfolio as a whole.